Welcome to the Financial Coconut Podcast Network, the leading personal finance podcast network in Singapore. I'm your host, Reggie, aka your Chief Financial Coconut, and every Tuesday you will be spending more time with me. And sometimes I will be bringing some friends along as I take you through various leading ideas that I find interesting and worthy of your time in the personal finance world today. I've decided to call this segment First Dibs, hoping that you and I can get first dibs on these leading ideas. Hey Coconut, so today we are going to talk a little bit about SSBs, Singapore Savings Bonds. Why? Because everyone's talking about it, right? The CNA feature, all your influencers, they're all talking about it because interest rates are moving up and you see the SSBs interest rates also moving up. So yeah, it becomes an interesting option. But the reality is, to be very clear, it is still not the most exciting tool out there. So the question now is, who should consider SSBs? Right? What about comparing it to bond funds, comparing it to other interest tools? Yeah, is it all about SSBs? So today I got a good friend on the show to share with us some factors to consider before deciding whether SSBs fit your portfolio. Finally, we are on set again today with Chun Ting. Nice to meet you again. How have you been?
Reggie, a little bit under the weather. I think there's another sort of wave of, I'm not sure what it is because it doesn't seem to be just COVID, but it's part of life, right? I mean, nowadays people get sick and then we a little bit down on productivity, but we just press on.
Yeah, I think we're both very sick today. So I'm also feeling a little bit under the weather. I also feel like it's another wave, because I got COVID previously, right? So I felt like there's some similarity. It's a bit of difference, but yeah, it is what it is.
Yeah, it's like it's, yeah.
So for all our listeners tuning in the first time, you've been on the show a few times, but for all the people that first time trying to get to know you, do a short introduction. Who are you? And all that jazz.
Okay. Hello, everyone. My name is Chun Ting Weber. I'm CEO and Chief Investment Officer of Money Owl. So Money Owl is your NTUC social enterprise that does financial planning. So for us, we are really thinking about how to bring great financial advice to enable people to live their best possible lives. Right? And our kind of financial advice, what we want is to offer something that is comprehensive and competent and conflict-free. Yeah, so that's us.
So you say outside don't have good financial advice, is it?
I didn't say. I say that I am the one providing it in this way, right?
Yes, I get it.
Don't start fights for me that I don't need to fight.
This one will go viral like that, right? Then you can...
Yeah.
Okay. That's not our goal. That's not our goal for today, right? You've been on the show a few times and talk about bonds and fixed income. I think it's like your pet project, like you love it. So recently there's been quite a whole discussion around savings bonds, like Singapore Savings Bonds, right? SSB. And I also saw a little bit of your feature on CNA, and then I was like, maybe I should ask Chun Ting to come and share with us a little bit more, like how do we then decide, is this an investment product that we should look at? Right, so maybe to begin with, you can kind of set the ground of like what is SSB and is it a bond? Like, is it different from a bond fund? All that jazz.
Sure, I think SSBs are kind of uniquely Singapore kind of innovation, and
that one from Tourism Board one, cannot anyhow use.
Is it uniquely?
Yeah, I think STB one uniquely Singapore.
Oh my goodness! Yeah,
yes.
Yeah, so
great.
The thing that I always say, which people get surprised at, is that the Singapore Savings Bond is not really a bond, right? It is structured like a bond, and it's called a bond, but it is different from a bond in several ways, right? Firstly, an SSB, when you can redeem any time during the term, and you will always get back your principal. So if you invest $1,000, you will definitely get $1,000, and then you get the kind of prorated interest in between. So this is quite different from bonds in that bonds, there's a price risk. A price risk meaning that if and there's a what we call duration, sensitivity to interest rates. So just take it simply, if you buy a bond today at $1,000 and it says it has a yield of 5%, so you get like 5% coupon, and the next year, generally interest rates have risen. So when interest rates rise, that means that the new bonds that are, say, 4 years or 5 years, are giving more than 5 or 6%. So obviously yours is less attractive, right? So what happens is that the coupon doesn't change. So what happens? Your price actually goes down. Because if you sold your bond to somebody else in there's 4 years, you have 4 years left, right? You sold to someone in the market, and then they'll say, okay, but then the new 4-year bond pay me more. So what happens is your price has to go down to make it sort of equivalent. So that is what we call the price risk of a bond. Singapore savings bond doesn't do that at all. Right? You always can redeem what you and get back what you call par, get back your capital. And
Capital.
so that's and therefore it's not sensitive to the interest rates. So let's say the new SSB tranche is issued at higher interest rates. You wouldn't suffer the effect of what I described just now with a proper bond. You will still get back $1,000 because the government will redeem it for you. So in that sense, it is not a traditional bond, and it's really capital guaranteed, and therefore it is like much safer than than bonds. It's really in the category of savings or even sort of cash. So it's quite flexible, except that you can hold it for a long time, or you can redeem it within 1 month.
Clarity, is it really guaranteed? Like, guarantee is a word, most financial people don't use. So I want to get clarity on that. Like, is it definitely we'll get back our capital? Like, is this part of the structure, or how is it going to look like?
Yes, it's part of it. It's guaranteed by the government of Singapore. Yeah. So unless the government doesn't default, otherwise you get it back, lah. Yeah.
Okay, very good. Yeah, good stuff. So then, compared to what is out there in the market today, right? I think a lot of people are looking at SSB more as like a defensive or more like a cash flow generating product, right? And today I have decided to get you on to give us some pointers, right? To get a bit of clarity on, like, is this for us, or should we just take on bond funds as like part of the 80-20 or 70-30, the usual kind of broadly diversified portfolio, right? So what is point number one for all our audience here to decide if SSB should fit their portfolio?
Yeah, so for SSBs, as I described, they're actually really more like savings, right? And so the first point is, what is the goal for the money you're investing? Like, is it really for an emergency fund to put as a kind of cash, or is it for the growth of your wealth? So if it's for emergency cash, then this is when it's important not to take price risk. And with bonds and bond funds, there is that price risk, such that when you redeem them, you might be negative, right? So this is what actually has been happening in the market with in the robo advisory scene, when there were quite a number of so-called cash management solutions, but they are actually invested. The underlying is actually bond funds, albeit short duration bond funds. Then suddenly, people say, "Hey, I thought this one is cash, supposed to return me 2%, 3%. How come I got negative 3%? The reason is because of the mark to market, or the prices of the bonds have gone down. So if that is not suitable for you, for your purpose, because you cannot take a certain percentage decrease in the capital, then you really are not looking for growth of wealth, or even a low risk growth of wealth, which is what bond funds are sometimes used for. So if your goal is to keep emergency cash, a cash stash and all that, right, then SSBs are suitable for you. But if you want to grow your wealth, and most of us want to grow our wealth beyond inflation, so beyond our emergency fund, you cannot depend on SSBs. You need to look at what we call capital market instruments.
SSB cannot make that kind of money, right? The government is not building this product to make you very wealthy. Yeah.
No, it's just savings, right? And it's great that savings rates have gone up, but inflation is also going up. And in fact, the reason why interest rates in general have gone up is because policymakers are increasing interest rates in order to dampen inflation around the world. So SSBs, or even low short duration bonds, you can't really think about growing wealth above inflation, especially over the longer term. Yeah, so So really the goal, go for the money investing in the first point. If it's really for cash, then for keeping rainy day funds, then yes, consider SSBs. But if it's for growing wealth, then SSBs are probably not suitable for you.
Interesting. So then, how in that narrow discussion of emergency and holding cash, right? Like, how much would you recommend people to hold in cash? How much is considered a good emergency? I think that's also a good thing to point out.
Yeah. So I think we recommend about 6 months worth of expenses as your emergency fund. So this is standard textbook for financial planners.
Why 6 months actually?
Well, the emergency fund is there to tide over usually loss of income. That is where you get your cash from to look after expenses. So if something happens to you, usually because of economy and all that, we should be able to find an alternative income within around 6 months. Now, of course, then there's some variation, right? Because you might be an entrepreneur and the business risk can be very large. Then it can go up to maybe 12 months. So we don't want to be excessive because if you keep 3 years and all that, right? You're probably underinvested. Yeah, so that might be too excessive. So usually we say 6 months and then going up to 12 months. So around there, you should be quite comfortable. Because bear in mind that, of course, the rest, if it's in liquid things, you don't, let's say it goes beyond 12 months, right? You might still have, if you still have needs, I suppose you can always liquidate some of your portfolio investments, but we try not to go there. That's why we say you have an emergency fund of around 6 to 12 months so that your financial plan, which is an accumulation, can go on without any interruption, even if something happens to your job.
So for clarity's sake, when people think about emergency, it's really like worst case, right? It's not something that is kind of like sitting around, because I think to different people, there's a little bit of a different texture in what is considered emergency, right? So sometimes some people look at like this kind of cash pot as a more fluid situation where you can just kind of move money in and out. It's okay. But to some people, it's like emergency means, right, this thing is macam like in the box with like 2 or 3 locks. Only cannot, then we'll take out. Is that what I'm hearing from you? Like it must be at that kind of intensity?
No, not really. So I think you're right. It's the complexion of the terms that we use, right? So I think for most people, losing a job can consider an emergency.
Yeah,
or stopping income is an emergency. I guess there's also general liquidity needs and all that. The correct term, actually, we call it liquidity ratio in the financial planning parlance. Right? So you can just say that it's basically a certain amount that you need for both daily liquidity as well as in case you have some unexpected expenses or unexpected loss of income. So it's up to you lah. And whatever it is, keep about 6 months worth of cash lah. I suppose that's that. So obviously then we said that SSBs will be redeemable within 1 month at the most, because it's at a fixed time of every month. Towards the end of the month, then they will actually give you proceeds. So you can't put everything and close down your POSB account and use only SSBs, right? I mean, you also need a bank account to apply for it. So you should at least, of course, keep the liquid stuff that you need there. Maybe let's say 6 months, right? Maybe 3 months in cash, and then maximum 3 months in something else that can be locked up to 1 month. Those are just very practical things. Yeah.
Okay. So wait, how do I then go about applying for SSB? Since you talk about it, let us just lay it for our audience. Like, if I want to do SSB, how do I do it?
Yeah. Okay. So firstly, you need a CDP account, because technically it's a bond, right? I mean, I say it's not a bond, but it is considered a bond in the government way. It's considered security, right? So it has a certain number and all that. So you need a CDP account, right? Then you go to your bank website, right? And basically make sure that you're all linked up and all that, and you can just buy it off the bank. Yeah. So you apply for, it's considered Singapore government security. So you apply for Singapore government securities on the bank, internet banking, and the 3 local banks DBS, UOB, OCBC, and that's it. And they will tell you how much you are allocated and all that.
Yeah, I heard recently very popular. A lot of people apply, cannot get.
I mean, when the rates are high, it's very popular, right? So I think last tranche, the allotment was 13,000 or so. The one before that was 9,000. Yeah, so it's still decent. But of course, if the maximum any one person can have of SSBs at one time is 200,000. So that's it's meant for ordinary people, lah. It's not meant for people with like millions and millions of cash.
Yes.
Yeah.
Yes, for people like you and I, middle income, ordinary people. Okay, brings us to point number 2. And what would point number 2 be when deciding if SSB is suitable for us?
Right. So firstly, we said the goal, right? Goal for the money you're investing, emergency fund or growth. So the second point is, what is the time horizon for this money that you're putting in to, say, SSBs or something else?
We will continue this afterward from our sponsor.
Great. So we're talking about the pointers for considering about SSB's investments. The first point we talked about was that consider what is the goal for the monies you are investing. Is it for liquidity emergency, or is it for growth of wealth? The second point is, what is the time horizon for this money that you are investing? So if it's for liquidity, I think just now we mentioned that SSBs are redeemable at the end of every month. So we must be prepared for up to a month's lock-in. So like I say, don't close down your bank accounts and actually you need liquidity in a normal kind of bank account normally, right? But if you're then talk about time horizon. If your time horizon is actually longer than, say, 4 years, you might actually want to invest it in a portfolio that at least has some equities to give you growth. Because it's not that you cannot hold SSBs for 4 years. Of course, you can hold SSBs for 4 years within your emergency fund. You can just let it remain there. But if the purpose of this, or rather the time horizon for these funds can be longer than 4 years, then you might want to consider putting it in something that has a little bit more risk, but can give you a higher return. Yeah, so I think that's the second point, the time horizon.
So then, what about for people that are looking at it, like to max out for 10 years? Right, because I think the longest is in the SSB, the whole time period is 10 years, right? So for people that have that kind of the whole horizon is like 10 years, they're willing to hold it too. Any thoughts on that for them?
Yeah, I mean, if it's within your kind of 6 to 12 months of emergency fund, you can just let it be there for 10 years, and that's fine. So there is there's both the kind of quantum as well as quantum in terms of what this represents in terms of your portfolio percentage, as well as your time horizon, right? So what I'm saying is that, let's say you already passed let's say you already have 12 months of emergency fund, and then you actually have money that you can lock away for longer, then of course you can take more risk with it. But if we are still looking at just rolling, or rather just keeping invested in this, and it's still within your emergency fund purpose, then for all intents and purposes, do that. I suppose this point is really a bit more like versus bond funds or versus equities fund. It's actually more a caution, right? To say that if you put money that you can lock away for a long time into SSBs, well, at most you just get the SSB return is a low return. But if you put money that you need in, say, less than 4 years' time into something other than SSBs, like a bond fund or equities fund, then you may not be suitable for you. You might bear a risk of loss because if you need to redeem it. Yeah. So in other words, SSBs are suitable as long as that money you don't need for at least, you don't need very soon. I suppose that's another way of putting it.
Fair. I think one more clarification is, am I right to say that once the SSB tranche is confirmed, like when it issues the SSB, and then they actually have a very clear every year what is the interest rate? So like the tranches and every year this is the interest rate. How is it going to look like? So once someone buys into it, this interest rates don't change, right? It is essentially a fixed thing for 10 years.
That's correct. Yeah. So you know exactly like this year how much you're going to get, and next year how much you're going to get in advance.
Great. Yeah. Yeah. It's essentially the beauty lies there that it's essentially no longer subjected to market movements at all.
Yeah.
Right? Interest rates outside change, equity portfolio change, everything can change. But this is the kind of guarantee that the issuer, which is the government, is going to provide.
Yeah, so you only have this like kind of envy lah. You say, yeah, I shouldn't have. I didn't dare to go and do it too early because next month one actually went up some more. So that is the only thing. But it doesn't mean anything for you in terms of you're still getting what you were promised.
Mm-hmm. Is there a little bit of thoughts that you can share with us as to how the interest rates are decided when it's issued?
Oh, okay. It's actually based on the Singapore government bond, Singapore government securities of the month before. Right? So the government sort of like looks at the 1 year, 2 year, 3 year, interpolate the thing and over 10 years. And so it is very, very close to the what the actual government bonds that are trading have traded the month before. Yeah. So I think it's quite open thing that they say. That's why they're able to determine it for you upfront.
Yeah, if you want to be super geeky, actually they have a paper that they publish, right? Show you the formula, everything, it's all there. So
yes.
if you want to go there, you can go there. It's on the MAS website, by the way, for all of you listening. I don't know, I think for us retail crowds, we just want to know, like, what is it like? How certain are you? Or what are the risk factors? Right? I'm not sure how many people will go and like really check the formula, But if so, you do, great, good on you. Okay, so cool. Then and this brings us to point number 3 of deciding whether SSB fits your portfolio, and that would be
what is actually the amount, the absolute quantum that you're putting into SSBs. And because that affects the application and redemption fees. And so don't underestimate the impact of fees on your return. The minimum amount of SSBs you can apply for is $500. Now, if you put just $500 in, you still have to pay the $2 application fee. Right? So this immediately takes it off the return. But it's not so bad. If you hold it for 10 years, that's fine. But if you, after 3 months, you want to churn, right? Then you need to think, well, actually, then, by the way, if you redeem it before 10 years, right, you actually have to pay another $2 fee. Okay? Because the banks are providing this as a service. They don't actually really want to do this business. It's just that they have to, right? Because government says so.
Part of the license. Right?
Yeah, correct.
You don't do, I don't let you do.
primary dealer, right?
Yes,
so all
yes,
that.
yes.
So that's why they're going to recoup all the costs from you.
Yes.
So when you're small, when it's a small amount, obviously the fees really eat into your return, right? So say I did a quick calculation. Let's say you are buying only $500 worth of, say, October's SSB, and October's first year interest is 2.6%, right? And you hold it only for 6 months. So what do you get is at the end of the 6 months, you get 1.3%, right? So you get $6.50 interest, but then you pay $4 in fees, and all that. So the effective yield is like less than 1% per annum, right? As a result. So your headline is 2 point something, but because you're doing this and you think that you're being very smart and clever because you redeem already, next tranche is even higher, but actually you have you just paid away a lot of fees. I think in investing it is quite something that costs are something you can control, and this is in fact it's probably one of the only things you can control in terms of cost, right? When it comes to investing, and costs always eat into return because 1% more fees, right, means 1% less return for you. Right, so that is very important to bear in mind for all investments, and as the frictional cost that comes with investments that particularly impact retail investors.
Yeah, and 1%, I think to a lot of people doesn't sound a lot, right? But when you compound it, you add together, it's quite crazy. So for all you tuning in, don't look down on that. Even that 0.5%, right? It's gonna make a world of difference 30 years down the road. Yeah, interesting. And you I remember you were saying like this is not the only product out there, that can do this kind of cash funds. In fact, there's some unit trusts that are like more interesting that could also provide something similar, and I think a lot of people, including myself in the early days, feel like hear this word unit trust very afraid. So because I think a lot of people got a lot of bad experience. It's like unit trust, 不可以啦, confirm fail, right? But it's actually just a structure, right? And I want to hear a little bit on that front, like what's so innovative about some of these new up and coming unit trusts.
Correct. Actually, they're not upcoming, you already have. Yeah, so I'm conflicted here because Money Hour carries one of these, right? And but before I talk about unit trust, I think I want to talk about alternatives to cash savings through SSBs. Right? And basically a few. One is fixed deposit rates. Of course, the thing about fixed deposit is that I think the last one I heard was I think about 2.6% for a certain amount, and of course it's fixed lah, right? So it's not as flexible as SSBs. And the rates don't seem as good. But then again, you can always get the quantum that you want ahead of time. There's also Singapore government T-bills. So T-bills are kind of 3, 6 months and even a 1 year. So they become quite popular because the yields are actually quite high because they're quite follow and you can buy almost as much as you want. Of course, if the demand is really overwhelming, the yield final yield that prints might be slightly lower. There are some fees. Again, it's something you apply through your banks. There might be some fees. But the main thing about T-bills is you please hold it for the tenure that you bought. Otherwise, there might be that price risk that we talk about because they are actually real bonds or what. So these are some of the alternatives where there is a guarantee, a proper guarantee, either by the bank within the deposit limits or the government. And of course, there are all these high interest savings account nowadays, right? If you do salary credit plus this, then you can get to know what, right?
This reward, that reward, a lot of things. Yes.
Correct. So that one is I think it makes sense if you are doing business with the bank anyway, like you already have a mortgage with the bank and all that, then put it in that account rather than the normal savings account. But the effective interest rate, because it's always tiered and it's always subject to you doing certain actions, may not be as high as the headline rates of 3 or 4 that they have been advertising. But it is a good option. And this is where it's really the liquid stuff that you do. Just be aware that sometimes, right, a lot of it is about hooking you to buy an insurance product so you can get a higher interest rate, right? So just make sure that you only do it if it's the best product for you. You probably end up paying more in fees than you get in the interest rates. Okay? Yeah. So these are the alternatives, each with their perks. And for me personally, I don't really bother that much with that. I just go with the DBS multiplier because my mortgage is with DBS, and then I just put what I have in there. So recap, the alternatives are the fixed deposit. With the bank, it's fixed deposit and this saving account. And then there's also the SGS T-bills for sort of guaranteed cash savings. Now, on this unit trust or cash management accounts, I think I mentioned just now that in the last 2 years, we have had a lot of so-called cash management portfolios come out, and they're formed with unit trust. And we need to look at the underlying. It's really caveat emptor, right? So just because somebody says this is a cash management account, calls it cash or something, you look in the underlying fund. If the underlying fund doesn't say it's a cash fund, it is not really made of cash. It's probably a bond fund. They might call it liquidity something or whatever, right? So just because someone calls something a cash management portfolio doesn't mean that it's really cash. You find like kind of China bonds in there and all that. High quality, short duration, but still it is bonds. It is not cash. Now, however, there are a few cash funds. Money Hour, we also carry one, and we put it under our Wise Saver portfolio, and it constitutes of the Fullerton Cash Fund. So this Fullerton Cash Fund is interesting because it started actually as a treasury management for Temasek. So I think you all know that Fullerton is a Temasek subsidiary. So what happens is that Fullerton takes the money, the excess so-called treasury money, right, and they start to place out into fixed deposits and ladder these various fixed deposits with the banks. But they structure it as a unit trust so that it transforms what is fixed into something that's very liquid. Right? So because they have this maturity that they have multiple banks, multiple partners, and they can negotiate for good rates with these Singapore registered banks. So are these deposits guaranteed in the same way as a bank deposit? The answer is no, because what you're getting is units of the unit trust. So what can happen is that if something happens to the bank underlying, right, the bank has obligations to the depositing entity, but not to unit trust holders. However, because the underlying is fixed deposit, it is very, very low risk. It's virtually no risk. The risk is actually the default. Okay, so what happens with these instruments, and what's innovative about it is that in times of rising rates, right, the rate goes up along with your time. So you don't have to say break your fixed deposit. You don't have to redeem and put in a new tranche of SSBs. It just goes up and up. So my MySaver portfolio today is rolling average is like 2.39% or something, and that's a gross yield. What you get, of course, is NAV to NAV, and then if you take away fund expenses of 0.15, it's still about 2.2 something. For something you can redeem within 1 day, is actually very good for what you get, and because of it is very safe, and you can buy as much as you want. There's no $2 fee or $4 fee. There are no fees. Right? There are no fees associated except for the fund expenses. For the management expenses that like I said is 0.15% per annum, but still net in your return will be definitely over 2%. So quite close to fixed deposit rates actually. And you can consider that if once you're maxed out your SSBs, or if you don't want it to be so mafan, you can definitely consider that. We have a lot of interest recently, and we had a lot of inflows because people realized that they want very safe and they want to take advantage of the use. So in fact, I have many banker clients, who say,
really?
No need to think about. Yeah, banker clients, because they work in the banks, they know what is worth it, right? And it's a fixed deposit fund that is not fixed. Right, so that's a fixed. We get close to fixed deposit rates that without having to lock in. Yeah.
Nice. That's interesting. Yeah. Wow. Thanks for coming on the show to share with us all these good jazz. And for all of you that would like to explore what Chin Ting and team can provide you, then you should check out Money. Or maybe we should put an affiliate link below in a podcast or something, right? We will arrange something, okay? But yes, please check them out. We'll arrange something. Please check them out. And I think Chin Ting is amazing, always coming to share with us a lot of good stuff. So I'm going to sum up today the 3 points in deciding whether SSB fits your portfolio or should you consider things like bond funds or equity funds. But specifically for SSB, point number 1 is, what is your goal for the money you're investing, right? Is it an emergency fund or is it for wealth growth? If it's for emergency fund and you need it to be very certain, you need it to be there, there's your 6 months expenses, your 12 months expenses, that kind of bottom line safety net, then yeah, definitely SSB is something that is very powerful and it supports your need for that goal, right? But if you're looking for something to grow your wealth, then maybe you can look elsewhere. SSB does not have the kind of interesting upside yield that some other investors are looking for. So point number 2 is, what is the time horizon for the money you are investing in? Of course, some people will say like, okay, 2-3%, not bad. That I just hold in for a long time and that's it, right? But the reality is, if you hold a lot of money in SSB or anything similar with the interest rates that are in this space, you're really, maybe you can consider yourself that you're under investing. You're not capitalizing on all the upside yield, right? So what are you really doing, and what is the kind of time horizon that you have with your money will help you decide whether SSB fits your portfolio. And of course, point number 3 is, what is the amount you're going to be putting in? And if you're going to be moving money in and out, right, then you're going to lose out in the fees, because you do spend money in trying to buy into SSB, which is about $2. And when you sell out, before the tenure is up, also $2. So yeah, I think for a lot of you small retail investors that are trying to build your portfolio, maybe don't think about it as like a bank account, like in, out, right? So fees will eat into your return. So with that, I hope you learned something useful today. See ya. Okay, Coconut. So I hope you found it useful today with Chin Ting, and I love it. She always comes on to talk about fixed income and bonds. I mean, that's her pet project, right? I mean, it's her first love. I mean, she said it in, I think, the 3rd episode of Chills. My goodness, it was like a year plus ago when I first interviewed her at her office with a lot of echo. I mean, back then we were innocent, very innocent with production. But anyway, I hope you found that useful. And I think recently there's just been a lot of hard times, a lot of noise, a lot of fluctuation in the market. US dollar continues to climb. It's affecting every other market because it's just forcing capital to move around a little bit too much, right? So yeah, maybe SSB is something of stability, can help you. But that being said, I think it's don't forget the long-term goals, although you may fear the short-term fluctuations, okay? Just protect yourself a little bit. But yeah, don't forget your longer-term goals. Next week, we're going to talk a little bit about recession, right? Since a recession is coming. Actually, I recorded this with Brian Halim, right? From Forever for Financial Freedom, right? Like Forever Financial Freedom. Yes, I think that's the very cheesy website name. And we'll also drop his link in the description below. So yeah, we also are dropping Chun Ting's link in the description below. So if you enjoy what she shared and you would like to explore some of the options that they provide, please check out the link in the description below to link over to Money Hour, okay, where Chun Ting is the CEO and CIO, okay. But next week we're going to talk a little bit with Brian. So actually I recorded this with him earlier, right? A little bit earlier when there was a first recession call, where the first time the market came down, the recession calls came in, and the US came out and say, maybe we want to redefine what is recession. So whatever it is, at the point in time, market was a little bit choppy and people were concerned. So I recorded that with him. But after that, a lot of things happened. It stacked and pushed all the way till now. It just so happened. Okay, bad news is just so happened. Recession continues to stack. And whatever you said, it's going to be very beneficial for all of us. So yeah, see you next week with Brian on the recession strategies for millennials, you and I.